Hey Bowtie Nation, Joseph Hogue here, taking advantage of what could be a huge opportunity in the stocks I'm buying in April. The Nasdaq is down almost 13% from its October peak. The Dow also in correction territory, and the S&P 500 could join both of them very soon. And yes, in this week's market update, I highlighted why the war in Iran could go on longer than expected, dragging down stocks with it. But with some of these top names in tech stocks trading for 50% and more from their peak, and approaching just too cheap to ignore valuations, it is time to start loading up. That's because, as possible as it is for the Iran war to drag on, there's also reason to believe it could be over in as little as 2 weeks. President Trump and the administration have repeatedly called out their 4 to 6 week timeframe given for operations. Now, in its fifth week, Trump has recently said that the US could just leave, and there's a real chance that negotiations or no, this war is de escalated very quickly. With or without the war, and maybe even with it, stocks in the economy actually look really good. I can go all economics nerd on you, and you know I want to, but it really all comes down to this. Analyst estimates for corporate earnings, here with the estimates for profits by year from companies in the S&P 500 index. Nation, earnings are the fundamental ownership for investors, what you're paying for when you buy a stock, on the hopes that those profits are going to go up and make the stock more valuable. And behind all the economic growth, the tax stimulus, all the other analysis I could show you that supports buying stocks right now, this is the only one that matters. Profit growth of the 500 largest companies in America is seen at almost 18% this year, an extremely high number, and more than that, that earnings growth has been accelerating every year since 2023. Nation, in no world do you see earnings growth accelerating to 18% and for stocks not to do well. That means the market right now is like a rubber band, ready to snap back higher with any news on Iran, and I'm looking through the news to find the best stocks to buy now. And one of the biggest trends over the last 6 months has been the model after model released by Anthropic in Claude there looks like it could crush software revenues. But now, new recent data coming out looks like it could be teaming up with some of these software players instead of killing them. Now, folks, the fact was always that with all the hallucinations, the software industry is just too important to just scrap and leave it all up to AI. Now, that doesn't mean there won't be disruption, given everything we know that AI can do, like one, the software companies now switching to a usage-based revenue model rather than that legacy seat-based. But like most sell-offs here, folks, the fear just took hold and went too far. And in fact, if we look over the last month, except for maybe the last few days, software companies were actually coming back and beating the rest of the market, rebounding from a lot of those sell-offs that just went too far. And all you out there in the nation know, cybersecurity is one of my favorite long-term growth themes. This is the one line item in a tech budget that just cannot be cut. But recently, we've also seen cybersecurity stocks falling on some of those anthropic models that look like they could do some of that work. Again, though, no company is rushing to replace a critical function like cybersecurity just to AI that can hallucinate and, really more importantly, can let hackers in on an undiscovered flaw. In fact, as I predicted a couple of weeks ago, we are seeing an increase in cybersecurity attacks, especially from Iran connected groups, even breaching the director of the FBI recently. Clearly, folks, cybersecurity is still the growth theme in tech, and stocks have sold off to bargain basement prices. Now, I'm going to dig into these numbers next, how I narrowed this list down from 13 to my 5 favorite tech stocks to buy right now, some at discounts of 30 and 50% from their peak to find those best deals. But you can see the stocks I'm buying in real time by joining me on the Blossom app with a special invite link below. It's totally free to download, and not only does it help support the channel, so I appreciate that, but you'll also be able to see what over 500,000 investors are talking about in the social feed. So look for that special invite link below, or just scan the QR code here. Here we see I put the numbers together on 13 of the top tech stocks out there, many of them the hardest hit in that software sell-off, and many that I keep hearing about over and over again in my research. And I want to take you through how I put this together, how I narrowed the list, and then highlight those 5 best deals that I'm buying right now. I'm going to use NVIDIA as an example here because who wouldn't use NVIDIA as one of their favorite stocks here, especially down 22% from the sell-off. I'm going to go through here, show you how I found each of these numbers and how I put this list together and then narrowed it down. First, we got here the price at $165, down from $212 at the peak, that 52-week range there in late last year. We also want the market cap, that $4 trillion market cap. Now, why is that important? Because that's going to give you a lot of the price to sales valuation. Okay, that market cap is just the total value of all shares in the market. So taking the price, that total market cap divided by its sales, gives us a very important valuation metric. But then here, this discount to 52-week high, while some of these are very strong discounts, this is probably the least important because it really tells us nothing about value. So we wanted some of these others. I also went here to Yahoo Finance in the analysis tab, looked for the expected revenue growth by year, as well as how much revenue the analysts expect the companies to report. So here with NVIDIA, here in the analysis tab, we see it's expected to post 71% revenue growth this year, 30% next year. So very strong. In fact, the strongest revenue growth of the 13 stocks I researched there. $370 billion in revenue expected there. So I put these numbers in there, the 52-week high, the $212 there, 165, and then let the model calculate itself. So I calculated, so we're 22% down from the 52-week high, revenue growth of 71% there, estimated by analysts for current year revenue growth. We got a price to sales. So again, that market cap, the total market value of all the shares in the market divided by the revenue expected this year, gave us a price to sales of 10.9 times. Price to the revenue. Again, not necessarily something that's going to tell us anything. We have to first compare that against the stock's own history. What have investors been willing to pay for that stock in the past? Okay, so right now, investors paying about $10.90 for every dollar in sales generated by NVIDIA. We don't know if that's high or low. Have investors been willing to pay more? And if the stock can get back up to those higher valuations, could it mean a good return for investors right now? So we got to compare it against the historical valuation. And then we also want to adjust that valuation to be able to compare it against other stocks. A lot of these stocks, very low price to sales valuation, but maybe the sales growth isn't so fast. So for example, we got here something like Microsoft only trading at 8 times price to sales. Okay, so that is quite a bit. That is less than Nvidia at 10.9 times price to sales. You could get shares of Microsoft here for $8.10 for every dollar in sales reported by the company. But here we see it's only growing those sales by 16%. So that is something, if you're going to be comparing these stocks against each other, you have to adjust this for that, adjust that valuation. So here's what I did. I took that price to sales valuation, adjusted it for the sales growth to find which are really the best deals in the stocks here. And you can see here, I highlighted, or I sorted each of these columns and then highlighted the top 5 stocks within each column to really narrow this list down. Now, finding that 5-year average valuation, really, where have investors been willing to pay? How much have they been willing to pay for that stock in the past? I'm going here to Morningstar data here under the valuations tab. You can find this. It gives you valuation data all the way back 10 years. What I'm looking at here is the 5-year average. Okay, so on average, over the last 5 years, investors have been willing to pay almost $24 for every dollar in revenue generated by NVIDIA. Okay, so that is very high. That's a very high valuation for NVIDIA. And if we go back, add that back to our data here, 24 times average valuation over the last 5 years, we can see that is almost twice as much as investors are willing to pay right now. It's a 54% discount what you're getting for those shares right now. So that means right now, compared to NVIDIA's own history, its own valuation, it is selling for a 54% discount. Again, taking that adjusted valuation, so adjusting the valuation, the price to sales, divided by the revenue growth, we can get an adjusted valuation that helps us compare this stock against the other ones, see which ones are really the best deal. Putting all this data together, being able to compare a stock's valuation right now with its historical average, as well as comparing it on that adjusted valuation against the other stocks, really helped narrow this down to see of these top 13 tech stocks, which are the best deal, which are growing the fastest, and which are selling at massive discounts to their own historical average valuation. Now you can see here, only Zscaler really ticked all the boxes here, all 4 factors. That's 59% discount from its 52-week peak, 24% revenue growth within the top 5 there. a discount to its average valuation. Right now, trading for just 6.6 times on a price to sales valuation. And folks, if you follow cybersecurity stocks long enough, you see that these stocks are never cheap. Okay, you don't get a stock growing its revenue at 24% a year and not trading at a very high premium on that price to sales valuation. But right now, because of that AI sell off, we are seeing a lot of these cybersecurity names selling at steep discounts. This one, Zscaler, trading at 61% lower, 61% discount to its 5-year valuation, 5-year average valuation of 17.2 times on a price to sales basis. Okay, not only that, but we can see here, adjusting for that 24% sales growth, we have an adjusted valuation of just 5.4. That again was within the top 5 cheapest, top 5 least expensive stocks in this group. But Nation, here's where you can't just rely on the numbers. It is a start. And you know I nerd out on numbers like this, but from here is where you also want to see with the stocks that give you the best deals like this and have that competitive advantage in software or cybersecurity to prove those numbers with a giant rebound rally. Now, besides that attractive discount and valuation, Zscaler excels in some of the highest growth segments of cybersecurity. Here we see the strongest growth in segments like cloud, SASE, and endpoint within cybersecurity industry. And digging further, Zscaler has a strong lineup in cloud and SASE, as well as participating in that agentic security. So definitely the competitive advantages to back up these numbers. So Zscaler, hard to pass up on these numbers on this discount as well as that competitive advantage. And it is definitely one I'm buying more of here in April. Now, most of these stocks, I actually already have a position in Zscaler. I own Microsoft, I own CrowdStrike Holdings, I own Palo Alto, Broadcom, Fortinet, I own Amazon, Nvidia, as well as Alphabet. So you can see I already own a lot of these stocks. And as I always say, folks, you don't have to always be searching for that next hot stock to add to your portfolio. A lot of times the best stocks are already in there. So this is why I like to kind of go over my portfolio, maybe add a few more stocks into the list, and then see which ones are really worthy of picking up more. And of that rubric, ticker RBRK is one that I haven't covered much, but I like it the more I research. This company has a strong cross-sell advantage, combining backup services, data security, and cybersecurity. And the numbers prove it here, down 55% from its 52-week high. The revenue growth for current year didn't quite make that top 5, but still very strong, still above 20% like we like to see in these growth stocks. Price to sales valuation very low. It's a 53% discount to that average average valuation it's traded at over the last 5 years, and one of the least expensive on that adjusted valuation. So not only is it cheap relative to its own history, but also cheap compared to the rest of these stocks. Coming down here, looking at Microsoft, ticker MSFT, Mr. Softy, might not have the fastest revenue growth at only 16.4% revenue growth expected this year. Still a little pricey on that adjusted valuation, but it is giving us a great discount, 31% discount to its average valuation. Microsoft's Azure Cloud Services is holding its own against Amazon and Google, and we're hearing about solid adoption of its Copilot agentic AI. So a lot of strength there. It's also a good value just on that existing business. And what I think here has a lottery ticket upside on its ownership of OpenAI, okay, ChatGPT parent. We saw over the last couple of months in that restructuring of OpenAI, Microsoft got almost a third, 27% ownership of the ChatGPT maker, a stake worth $130 billion right now. Now at a market cap of about $2.6 trillion, and with the OpenAI planning to IPO later on this year, it could be a windfall for Microsoft. Now, I know everybody wants to pit OpenAI, Anthropic, and Gemini models against each other, but what we're actually seeing is that customers, enterprise and consumer customers, are using more than one model. So there is still room for multiple winners here. Okay, Claude, Anthropic is used by more enterprises, but GPT is still by far the runaway leader in consumer AI usage and is getting a strong growth from enterprise. So I think OpenAI is going to do very well in that IPO. A lot of investors are going to want a piece of that. That is going to be a windfall for shares of Microsoft. Down here, Cloudflare, ticker NET, is another stock that just keeps on coming up every time I research software stocks, including last week's collaboration with the FinTech channel. Now, Curran pointed out that Cloudflare is ready to head off the AI threat with its usage-based model instead of that legacy seat-based model for software revenue. Now, I think Cloudflare has some undiscovered levers here as well for that upside. Not only does its content delivery network and the security put it in front of more than 20% plus of the entire internet on the planet, it's now got a giant infrastructure advantage in edge computing because it's got those servers positioned around the globe. And here, looking at ServiceNow, ticker NOW, it's just too good to pass up, with shares down 50% from its peak and trading as one of the least expensive when you adjust for that growth. Okay, leading software CRM provider there, down 50% from its peak, a 20% revenue growth. So not huge revenue growth compared to some of these others, but very strong still nonetheless. 6.9 times on a price to sales basis. That is less than half. That is a 56% discount to what investors have been willing to pay for this stock in the past. Okay, over the past 5 years, investors have been paying 15 times price to sales. So $15 for every dollar in sales generated by this company. Now you're getting that for about $7 price to sales. Okay, $7 for every dollar sales generated by the company. You're getting that at a huge discount. And compared on adjusted for that value or for that growth, you're getting it at much cheaper than a lot of these other stocks. So those are the five that I am picking up here in April. Zscaler, ticker ZS, Rubrik, RBRK, ServiceNow, NOW, Microsoft, ticker MSFT, and Cloudflare, ticker NET. I still like a lot of these others, all of them in fact, and own most of them, even if they didn't make the list to double down on this video. Now we can go through here some of these. CrowdStrike got an analyst upgrade Monday. Still a little expensive to be adding more. I've already got a big position in CrowdStrike, what I think is probably the de facto leader in cybersecurity with its Falcon platform. So love CrowdStrike here, but a little bit too expensive still to be adding more. Next here we got Meta Platforms, ticker META, and Amazon, AMZN, both of them trading at a steep discount from those 52-week highs, and both very strong revenue growth. Well, 25% revenue growth for Meta Platforms, not quite so strong at Amazon, but that is a big ship to turn. 13% revenue growth on hundreds of billions of dollars in revenue is still pretty darn good. What I like about Meta is it's getting a big boost from AI in its advertising segment, now the fastest growing segment within that. Zuckerberg trying to revolutionize advertising with AI and doing a pretty good job of it. One of the cheapest or one of the least expensive stocks on an adjusted valuation basis here, as well as Amazon, the least expensive among all 13 stocks here. Didn't quite make this list though. Here, Palo Alto Networks, ticker PANW, also have a big position in that. Saw some insider buying from the CEO on Monday. Again, I already have a big position on that, and it didn't quite make the list for valuations there. Only a 5% discount there from its average valuation over the last 5 years. Broadcom, ticker AVGO here with some monster growth, almost 64% revenue growth expected this year. Probably one of the best infrastructure plays next to NVIDIA. Okay, all you out there in the nation know I'm a big believer in the infrastructure, the AI infrastructure play. We are seeing at least $700 billion spent by the mega or the hyperscalers into AI infrastructure. That's the data centers, that's the servers, that's the chips, the accelerators. Broadcom, other than NVIDIA, no other company has as much input into that data center infrastructure play as Broadcom, and we see it here with the 64% revenue growth. Didn't quite make the list here just on that premium to its discount value or to its valuation, okay? So right now, shares of Broadcom trading for about 13.3 times on a price to sales. That is actually still below the 11.2 times average valuation over the last 5 years. So this one has come down a little bit, come down about 30% from its high, but still trading pretty expensive just compared to its own history. Next up here, NVIDIA, ticker NVDA, looking really good on some of these numbers, down 22% from its recent high, 71% revenue growth, highest revenue growth of all 13 stocks here, and a 54% discount to its average valuation. So this stock trading for just 10 times on a price to sales basis. That is less than half the 23.9 times average valuation. So huge discount there. It's trading relatively cheaply against a lot of these other stocks. But one, I worry if it can keep up this revenue growth against competition from AMD and Broadcom. So I do think we start seeing that revenue growth come down, might continue to disappoint investors in NVIDIA. So I hold the shares, but I'm going to hold off on what I own right now. See the stocks I'm buying in real time and join over 500,000 investors on the Blossom app with a special invite link below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.